Whoa.
Wait.
Oh my God. It's not us this time. It's not us.
Oh,
All
man.
right, we're just going into it. I feel half cocked here. You know, I need the music to get me going.
Well, the help is fired.
Listen, welcome to the I think the help is frozen. I don't know what's going on. Let's try this again. Welcome to the Pirates of Finance, the the show where you got two finance bros trying to do a completely scuffed podcast, I guess, about finance, where we're rarely talking about finance or what we actually do for a living. Jason, I don't know if you just noticed, but the technical help has abandoned us, so we're gonna have to figure out how to run this show on our own. We're your hosts. The incredibly handsome man across the mic from me is the one and only Jason Buck, aka the Young Hemingway. My name is Corey Hoffstein. Nothing we say or do should be interpreted or even remotely considered financial advice, tax advice, life advice, parenting advice, really advice of any sort.
Drinking responsibility advice. Don't drink. Don't drink and drive. Drink responsibly, because we'll probably talk about drinking.
Yeah.
Just cover all our bases here.
Don't do drugs. I don't know. We'll just go through them all.
Drugs are bad. Okay.
I want to start hard and fast here. I know this is one of your favorite topics, Jason. PCE came out hot this morning for the macro take of the day. Jason Buck, over to you.
PCE came out. That I have no idea. I've been on calls all day. I haven't even looked at it. There you go.
Thank you, Jason. Thank you for that. All right, look, I don't actually want to talk about macro. We got a couple things to talk about today. I think we're actually, for those tuning in, we are organized. We're going to start off with a little discussion on 0 day to expiry options. We're going to then maybe talk CTAs. And then we're going to talk everyone's favorite topic, NFT yield farming.
I love it. We're coming back. It's coming back.
It's coming back, baby.
It was great to see you in the chats again, posting all this crypto content, because it's been a while.
Nothing gets me more jazzed up than just thinking about trading JPEGs. Like illiquid JPEG trades just really get my heart going.
And is this my indicator that crypto's back? Because now you're starting to clog up our text threads with NFTs again.
No, this is all going to end in tears, but we'll get to that at the end of the episode. Let's start with 0 DTE options here. So I got a great note across my desk this morning from Goldman Sachs, from Scott Rubner at Goldman Sachs. Writes a great note, sort of a flow-based note talking about CTAs and target vol strategies and positioning there. And obviously, there's been a lot of attention paid recently to these 0 DTE options. People who are buying and selling options that are expiring in the same day. The amount of open interest and volume in these options has gone up dramatically post-COVID and continues to climb. The recent color has been a lot of these are written put options, but there was a really interesting print yesterday that I wanted to highlight, and this comes from Scott's note. So at 10:40 a.m. yesterday, Eastern time, 26,000 put options on the S&P E-mini futures were struck at a strike of 4,000. So this was the equivalent in strike notional of 5.2 billion, and whoever bought this big block trade paid 5.5 million. These were about 40 delta options, which meant that the dealers on the other side of the trade had to basically immediately hedge with 2 billion worth of delta, right? So let's translate that. Someone bought a shitload of puts that were expiring on the same day, it basically resulting in an immediate market dump of $2 billion worth of notional in the S&P 500. The option started to pick up delta as the market sold off throughout the day. And that's where, as equities sold off, this basically caused that pro-cyclical spiral of the dealers starting to have to sell more and more and more as it went more in the money. And then sometime around lunch, the equity market reversed, and all of a sudden you got the dealers having to cover and start to buy their positions. Just for context here, top of book liquidity in the S&P 500 E-minis is like $10 million. But because these are 0 day to expiration options, that initial delta sold of 2 billion all has to be covered by end of day because they're going to expire. So at some point, the option dealers who hedged with that 2 billion have to buy back the 2 billion worth of options in the same day. This was absolutely an institutional trade. This is not like an aggregate retail trade. You had someone who decided to buy this massive put option. By the way, this was after all the macro news came out that was going to expire within 5 hours at pretty big size, right? Premium paid of 5.5 million, $5.2 billion notional strike exposure. So the largest 0 DTE trade that Goldman has on record. They say it might be one of the biggest, or the biggest they've sort of observed. They got to go back and check the data. It might be the biggest ever on record. Pretty sort of shocking in size, but I think what has shocked people more is the amount of gamma hedging exposure, right, that comes from a position like this. And if it continues to happen, does the market even have the capacity to digest it? So a couple open questions. First, what the fuck? Like who
buys slightly out of the money puts with 0 days to expiration?
Yeah, buying a 40 delta put with 5 billion notional, right? Paying 5.5 million just to expire in 5 hours. Like, to me, this clearly isn't a standalone trade. This was either someone who was trying to I don't know, hedge some gamma, or this was part of a multi-leg trade that we didn't see the other side of.
Yeah, especially without market news, it has to be the case that we're not seeing the other legs of the trade. Also, just to clarify, you said for the dealers to buy back the options, you meant the futures?
Yes, thank you. They have to they have to buy back the futures that they hedged with.
Yeah, and I almost wanted to give you a yellow card for talking about the notional value, 5 billion of these puts, but like, because that's how you get into a morass of arguments with notional value, except for, like you said, the notional value of the dealers hedging in the futures is $2 billion. So there is a value to the notional in this sense, where you have to at least discuss notional. But even that in the futures, right, they're using intraday margin or maintenance margin, so it's not like they're putting $2 billion in cash to work. So that's a little bit just of the nuances there. But the other thing, when you sent this to me earlier, and then you said the other thing I want to clarify, you said top of book liquidity, which drives me crazy too, and I know it does to you too.
I'm hitting all your little jab points. I'm giving you talking points, buddy.
I know you're doing it. I know you're teeing me up, but like top book liquidity doesn't mean anything anymore with, iceberg orders, spoofing, everybody trying to, red queen principle each other when it comes to order execution these days. But what actually I went the reverse is I was like, man, they digested a hell of a lot of liquidity there. Like both the options purchase and the dealers hedging, and one, it moving short the deltas originally, and then swinging back the entire other way intraday was shocking to me. Like you said, that amount of liquidity was covered and seemingly efficiently for all we know. So that was what's more like surprising to me, is everybody's talking about there's no liquidity, and yet this actually played out on an intraday basis. And then the third piece that's kind of surprising or interesting to me is, like, I think whoever put it on, like we said, we don't know the other legs of the trade. There's been all these hints lately of whales coming in, where Jem Carson thinks it's Carl Icahn, or I always wonder if this is Masa-san. What's Masa-san's fund? I always forget the name of it. I can't think today, but at one point they were doing some crazy options trades a few years ago. Didn't pan out for them, but you don't know if they're trying to, like, maybe it's them trying to take advantage of this again. But obviously the trade was likely without, let's just say we don't know the other legs. Let's just say this was an intraday, like, speculative trade, and they really thought they could move the dealers. It's shocking that it didn't cascade into a sell-off and they were able to take advantage of it at that size. That's the way I would look at it.
Well, there's really, I don't want to say there's only two paths. There's way more than two paths, right? But there's sort of like two things to consider here. The initial sale, right, where, okay, you get a 40 delta on 5.2 billion strike notional, resulting in 2 billion that needs to be hedged, right? So the market has to digest that $2 billion sale, no vision fund, $2 billion sale immediately, right? But then there's the secondary impact, which is, all of that hedge needs to be bought back by end of day. So the first part is, okay, is that enough to send the market cascading downward? And then the second part is, well, that there's going to then have to be whether it even goes more in the money and there's more downward hedging pressure, right? That pro-cyclical hedging pressure, all of it has to come off by end of day.
They have to cover by end of day, yeah.
They have to cover it. So there's really like two big, like it's a mean reversionary effect, right? So the thing that comes to mind for me is, okay, if this is becoming more prevalent, like are we going to see a return of intraday strategies? I don't know if you recall, right post-COVID, that tons of banks were talking about their intraday trend strategies because they made a fortune in March 2020, but they all suffered tremendously through the rest of 2020 and 2021. I think if I look at like the Deutsche Bank intraday US Trend Index, and again, I'm not trying to pick on Deutsche Bank, it's just an easy one you can find on Bloomberg. They gave up all of their profit and more of the March 2020 spike in the latter part of 2020 and 2021, arguably because a lot of those vol sellers had disappeared. And so a lot of the hedging pressures that were creating intraday trends were gone. But then beginning of 2022, intraday trends started to work again. Had a bit of a rough December, but it's been working in 2023. I'm wondering if the return or the growth of these zero DTE dynamics is going to make that strategy more attractive.
Yeah, I think a manager we both know of is like takes really advantage of that end of day covering with their intraday trend following strategy, which has worked well intermittently. So that seems to be back. Related to the zero DTE, what I just want to bring up, some people are calling for a Volmageddon or Gammageddon of this, but it's interesting is like out of all the vol managers I know, which is 30, 40 managers, like half think zero DTE is something to pay attention to and that there's a potential Volmageddon, Gammageddon, and the other half are like, it's absolute nonsense. And anybody saying that is full of nonsense. So it's like, I like when it's really bifurcated like this. It just makes me pause and kind of pay attention and all that stuff. But like, I would be hesitant to jump on board either of those directions where the truth is probably somewhere in between.
Yeah, I think what has been the most intriguing part of this for me is the source still seems to be a mystery. Right? You get this massive print yesterday. Nobody knows who it is. Nobody knows why it is. I haven't seen anyone clearly connecting it to another trade. Right? I talked to a bunch of market makers in the option space about all this zero DTE volume. Maybe they were just holding their cards close to their chest. They tell me they have no idea who it is. Right.
Well, that's usually we get a exciting like avatars, right? Like 50 Cent back in the day,
right.
Right.
Who I guess is back, by the way. Ruffer is back.
Oh, they're probably always back. They're always going to be at least.
I just saw some news this week that they were heavy buying VIX calls, 50 Cent VIX calls.
Probably because I mean they opportunistically hedge, but they're also, as you know, like we're saying, we don't know what the rest of the legs look like. They're running like last night well over a $30 billion book. So everybody's like, looking at their hedges and it's like, oh, what other book are they hedging, right? Like, and they're very, very opportunistic, very specific about what they're trying to hedge. So I wouldn't be surprised at all if they're back, depending on what their other exposures are, which, the same, they think about their overall book and the emergent properties, not necessarily just trying to make money off hedges.
Yeah. Hot take, do you see this zero DTE activity as a risk potentially?
So I'm saying, I think, talking to all the managers and going back and forth and just asking people like, what their thoughts are, everything. I don't see, but here's, let me take a step back. I don't necessarily see the risk, especially we just saw like that amount of liquidity get moved around. It was kind of fascinating to watch, but also at the same time, the whole point of not seeing risk is that it's a black swan and you can't predict where the risk or the cascade of that risk is going to manifest. So not seeing the risk currently doesn't mean I'm missing the outside risk or the tangential risk or the adjacent risk that's possible in these sorts of scenarios. The only thing, in general, like little things that are obvious, like it doesn't affect, VIX because it's, 1 month forward variance, you're talking zero DTE. The other thing is like these market makers and dealers are not stupid. They're going to be starting to extract an exorbitant rent for these
Right.
options. You know, like they're
Right.
and they're very dynamic in the way they're going to cover that risk and offlay that risk.
Yeah, the way I've been thinking about this is if it is indeed having a larger impact intraday, great. Just one more piece of evidence for me to keep ignoring intraday movement, right? Like one more reason just to say, yeah, economic news came out. Whatever the reaction was, probably had nothing to do with the actual economic news. The voting machine is becoming more and more volatile in the short term. So great. I'm just going to ignore that in the short term. Long term, again, I don't know because I don't know what the offsetting positions are. I don't know how, like, are these just naked trades? Are they being played? Are they being offset elsewhere? Right. I mean, who says that manager didn't put on those puts and then, buy a bunch of E-mini? There's like, you just don't know. There could have been offsetting delta. And then as, the gamma was being laid off throughout the day, or they were trading the dealers were taking off their hedge, like the person on the other side could have been taking off their position as well. You just don't know who's matching the liquidity in the space. So I just think there's so much unknown here about who's doing it, why they're doing it. I don't know. It just makes it hard for me to say like we should be concerned about this.
Yeah, to you it's just noise. Is that what you're saying?
Yeah, it's just noise. I mean, it's something I want to keep my eye on. But again, like, if it is becoming overwhelming, I guess my thought is like, if it's becoming overwhelming, you would expect the option dealers to adjust their pricing, right? The option dealer, like the way I think about all this option stuff is that people are just able to lay off the position they want, the delta position they want on dealers, right? And you're playing in the world of implied vols. But if you're just like a degenerate gambler who's using 0 DTE as a binary gambling option, right? You're effectively laying off a levered bet for the dealer to execute on your behalf. At scale, that's kind of dangerous, potentially, right? Can the dealers ingest it? Can the markets ingest it? But in theory, the dealers should know better than anyone what they can ingest and hedge. And so once they get to the point where they can't digest the volume anymore, they're just going to change their quotes and extract more and more value. And then it's just going to become a highly non-profitable trading strategy. And they're going to disincentivize people from trying to stuff them with more volume.
Yeah, like those quotes will surprisingly disappear when you go to execute.
Right.
But what's been actually surprising, I was saying about they're going to extract their rent, but like actually they've been making pretty tight markets still with the rise of 0 DTE. It's actually surprising how tight the markets they've been making. So yeah, it'd be interesting to get much more like deal. I know you and I have talked to a few of them, but it's hard. Yeah, obviously they're KG too because they're money printing machines, so they don't really want to tell you about what's really going on. But yeah, we're always trying to find out different factors involved. And by the way, in the comments, SOS asks, how could the exchange's daily circuit breakers factor into this? Relevant or not relevant? I mean, I guess you could push it to a circuit breaker, but either way, I mean, circuit breakers are there, and they're going to be tested from time to time anyway.
Yeah.
I don't know. Did you have any thoughts on that?
No, I don't have any particular thoughts other than like, I mean, could someone try to stuff the market with such massive size that you hit a circuit breaker? Maybe. Like you'd have to deploy a shitload of capital into a pretty illiquid market. And again,
but the dealers have to voluntarily take that
right.
Toss, right?
Exactly. And that's the point. The dealers have to be willing to be on the other side. I guess the question is, are the dealers going to understand their risk profile well enough to know that they can hedge this and widen out their bid ask, lower their, on-screen liquidity prior to being overstuffed? Or are they potentially going to find themselves over their ski tips? That's always the question with these sort of things. And plenty of people have found themselves over their ski tips in the past, so I don't discount that risk.
Well, I can't wait for our market maker friends to be DMing us, tell us how stupid we were today and like how we don't understand anything, and they're going to give all of their hot takes.
It wouldn't be a Pirates episode if I didn't get an email or a DM afterwards with someone telling me I'm stupid. That's just how I know it was a good show.
But
all right, let's talk about the CTAs.
Okay. Oh, well, yeah, this is a perfect transition. So I got you. Is that speaking of liquidity, I've been like catching up on a lot of like CTA interviews and everything since Miami. And one of the ones I noticed with Crable, the CEO of Crable is Michael. My apologies, Mike. But like Crable was talking about the volatility adjusted liquidity is fine. And that's what, like, most people are going to really implement their trades on the volatility adjusted basis. So as volatility expands, they're going to execute less trades. So he's saying like volatility adjusted liquidity they find is fine. And even in March of 2020, SPX blew out 4 points on that spread. Like that, he said that's the highest he's seen in basically his trading lifetime. But once again, if you're able to execute, you may not get the price you want, but like this is the other part of liquidity I don't understand is like, yeah, you might not be able to execute a tight bid ask spread, but if you could still move liquidity and size over a day or a few days, it's the target's kind of a moot point to me.
Yeah. The idea of volatility adjusted liquidity is interesting because, again, it goes back to the question of, especially among CTAs, some of them are going to vol adjust their position size and some aren't. Right. This is one of the things that creates such massive dispersion in the CTA space. I think most of the quant oriented CTAs tend to vol adjust and they vol adjust their whole book. Right. They're going to take the covariance matrix into account. The more traditional turtle traders, they don't. It's more of like, I put my risk on in my position, constant dollar size. I don't really care about what the vol is. In fact, I probably want to ride vol as much as I can because that's when the big trends happen. Two very different philosophies. But I think, again, as CTAs come into vogue again, a big question is, what's the capacity of the entire space in some of these contracts? And if you're vol adjusting your liquidity, right, ideally you're decreasing your footprint when markets are most volatile, which might be helpful.
And there's so many things in there I want to pull on, but one, yeah, you nailed right away. There's like static versus active risk sizing, but also to be clear, the ones that when they're putting on their position, they're still volatility adjusted the original initial position sizing, right? Because they're using ATR or average true range like to put on their position size. So as they put on new trades after volatility is expanded, they're likely, first in, last out, depending on their true range, how many days, they're likely to have a smaller position size once volatility is expanded. And then this is the eternal argument, right? Is static versus dynamic risk sizing. Where do you actually come down on that? Like, do you volatility? Like, do you think that CTAs should vol weight adjust their positions after their open positions? And like you said, the one trade up, I'll give just a general statement, 30,000 foot view. Is the turtles argue that by not changing their position size, they're open up to expansive volatility, and they're gonna argue they're gonna capture more profits from the trend. And by vol adjusting, you may improve your Sharpe ratio and may improve some of your risk metrics, but you're missing out on those really outlier big moves. Is that fair to like?
I think that's fair. Where I am going to come down on this is with a hopefully nuanced answer where I can dance across this fine line where I don't have to answer. I actually think there's an argument for both, and it might be dependent upon the correlation of returns and variance. So one of the things you find with equities, for example, is volatility and returns are actually negatively correlated. Volatility tends to expand when equity markets exhibit negative returns. That's why vol targeting has historically been a proxy strategy for trend following. As vol picks up and you reduce your position size in equities, it tends to look very similar to, okay, trends were negative, so I'm going to reduce my position size. What that means, though, for trend followers who are both following trends and position sizing, is it's cutting your position double, right? You're going to go from positive to negative, and then you're going to go from negative to small negative, right? You don't get more negative. You actually decrease your position size. So what you find with those types of managers is equities actually don't have a huge impact on their long-term P&L. Like when you look at a lot of CTAs, 2008 was not getting the call on equities right. It was getting the call on bonds correct. Last year was not getting the call on equities right. It was getting the call on bonds and dollar correct and oil at the beginning of the year. It had almost nothing to do with equities. The same correlation between returns and volatility, though, does not hold in other asset classes. Commodities are known to crash up, for example. Bonds have historically crashed both up and down. So you can get more of a smile profile. And so I think the answer is nuanced. I tend to default to I'd rather risk adjust my position size and just understand the risk I'm playing than leave more open risk. That's more of a defensive stance to me, but I think there is room for actually a per asset class nuance here.
So you would think about adjusting your vol on the individual asset classes, not on the portfolio as a whole.
Yeah. And it gets really hard when you go, do I sort of vol target positions versus vol target the portfolio? Because vol targeting the portfolio, then you have to start talking about correlation assumptions. And that's a whole other can of worms.
So you and I kind of have somewhat endlessly debated this, but like if you say that CTAs are replicating a long straddle, I would argue yes, historically when they would add to positions over time. But now if they're vol targeting, does that kind of break apart your analogy to CTAs being a long straddle?
No, I think it actually makes it tighter, right? So if you think about the delta of an option, right, what happens to the delta of the option when the implied vol goes up and down? Right? If the implied vol goes up, right, and nothing else changes, your delta should go down, right? And then vice versa. So if you are basically running a signal that looks like a Sharpe ratio, right? I'm going to look at historical returns and divide it by vol. That Sharpe ratio very much looks like what the delta of a look back straddle would be. And so as long as you assume implied vols are correlated with realized vols to a certain degree, I think actually vol adjusting the position is much more in line with tracking the delta of the straddle.
You track the delta of the straddle, but like I guess to your point too is gamma's as high as at the money. So actually that long straddle as it moves, it's going to start losing some of that gamma profile though. So it's not long gamma.
I mean, yeah, it's a little weird, right? People talk about CTAs being long vol, talking about replicating the straddle.
No.
I don't think CTAs are long vol at all. I think CTAs within a single day, right, that are coarsely replicating the delta of this look back straddle. So what do I mean by that? If you are running a very simple model, 200-day moving average, and you're above or below, or let's make it simpler, 200-day look back, right? Above or below, if your return's positive or negative, and then you're going to risk adjust that. It's sort of like saying, where was the market 200 days ago? That's my strike of my straddle. What's the delta of that? That's the delta I want. How do I come up with the implied vol for that look back? I'm just going to proxy it with realized vol. And you've waved your hands enough that that's what it sort of looks like. The next day, though, you need to move that straddle a day forward, right? So it's like you're sort of like instantaneously point in time coarsely replicating the delta of this straddle, but it's not as easy as saying like, oh, there's one very clear straddle you're looking at. It's moving throughout time. You generally have this coarse delta replication, but it's not like you can just buy this option off the shelf. Like this is a weird OTC option we're talking about.
Are you saying that reality has a surprising amount of detail and just talking about CTAs as a long straddle is not a nuanced way of thinking about it?
I'll tell you, I'm a really shitty salesperson.
But no, this is perfect because it led me into actually another one of the things that finally I found I feel like Diogenes with his lantern, looking for an honest man. And thankfully I had Ryan O'Grady from Bro that said that CTAs actually have a daily skew that's negative, and they're long, low frequency vol and short, high frequency vol. And I was like, finally, this is one of the things I've always been talking about. So I'm obviously biased towards this opinion, is that, depending on trending markets, if like the stock market was in an uptrend, let's just use stocks, for example, and then we have a liquidity event or liquidity cascade, TM, they're going to be caught on the wrong side. So their daily skew, they tend to exhibit a daily skew that's negative. And this is what I kept banging the drum about that finally happened in March 2020, where they got caught on the wrong side. And this is why you need things like long volatility tail risk, at least in my opinion. But I just love the way he put it too, is like they're long, low frequency vol and short, high frequency vol. I'm just curious if you had any thoughts on that.
Two big thoughts. One, I want to connect back to like the trend following versus options. We just said, let's think of trend following as a coarse delta replication. Delta replication works in your nice sort of clean room environment where you can continuously hedge with no market impact and the market moves continuously. When all of a sudden there are discontinuous jumps and you're discretely delta hedging, you will not replicate the payoff of that option, right? So an argument for why would you pay up for an option versus discretely delta hedging is because you are getting rid of that jump risk, right? So to your point, like if I were able to discreetly delta hedge the position without market impact, or excuse me, continuously delta hedge the position without market impact 24/7, maybe I would have better performance, trend following in a March 2020. But when there's overnight gaps and I'm discreetly managing my position, yeah, I'm going to take it on the chin in a way that the option contract is actually going to protect me, right? So important distinction there that I want to address, like that disconnect, that discrete hedge versus what's implicitly happening continuously embedded within the option contract, I think is a really, it's a risk distinction between the two, and it's a trade-off you're making.
Before you go further, I just want to point out this is like an after-school special, like with the more you know star is like, this is perfect. Is that jump risk is not included in the Black-Scholes formula, kids.
Thank you. But I love what you're saying about this idea of like negative skew on a daily basis, because I actually think it's more subtle than that. It depends wholly on the speed of the trend following strategy, right?
Correct.
So Arthur Sepp had a great article about this a few years ago where he said, look, if you are running a long-term trend following strategy, the convexity that is exhibited is long-term, right? Don't run a slow moving average trend following system and expect to see convexity over a day, right? Like, it's not going to react. And I think you can, again, tie this back to options. If I buy a very long-term straddle and price moves today, the delta of that straddle isn't going to move much, right? But if I buy a straddle that expires in a week and price moves a lot today, you better believe the delta is going to move a lot, right? So, right, if I run a very fast trend following system that's looking at the past week, it's going to be very reactive. You still have the jump risk, but it's going to be very reactive. If I run an intraday trend following strategy, I'm not expecting negative skew necessarily on a daily basis, but I will expect negative skew on a daily basis with a slow moving trend following strategy. And so I think this understanding options through this, understanding trend following through the lens of options, and that trend following is this very coarse delta replication, I think is a very useful framework. It's not perfect. There's tons of holes in it. And understanding the holes, I think, gives you even more sort of nuance to the problem. But I think all these things that you're talking about have a very clear answer when you consider it through this alternative framework.
That's a great way of putting it. Like, it's reality has a surprising amount of details. There's more nuance. So then we start picking this apart, and then they sees you how to construct a portfolio. Like, for example, like to your point, like I know Nigel at Quest, they use like vol expansion as part of their model. So like they're a very short-term vol expansion environment. So that's very different, like you're saying, than a long-term trend follower that's maybe using a 200-day, or moving average crossover versus breakout. All those things matter on whether that's a crude straddle replication or not. And like, once again, it's like you really have to dive into these different strategies to kind of figure that out. Some of the other things that came up, go ahead. Sorry. Did you want to?
No, I was just going to ask you. I mean, a lot of these I think were on Top Traders Unplugged, right? They've been doing a phenomenal series. So shout out to them. If you're interested in CTAs, they've been having some heavyweight managers and really phenomenal interviews. I'm curious though, what led you to go down the CTA rabbit hole, like catch up with all these podcasts?
No, it's it's normally I listen to almost probably every episode of Top Traders Unplugged. And when we were in Miami for those few weeks, everything, I just got behind on everything. And then they did this amazing series with some of the biggest CTAs. And I'm like, I'm just going to like plow, like once I get some free time, I'm going to plow through these and catch up on all these. So this week, or last few days, I've been catching up. I still have a lot more to go. So maybe I'll be able to talk about more of it next week, but it's always great catching up on a lot of that stuff. I mean, it's already stuff we kind of already, I mean, you and I probably know all of it already, but you never know what like little nuance you're going to pick up. And just Ryan O'Grady saying that was great. I thought, I mean, I texted you right away about it.
Yeah, I have really appreciated, and I have not caught every episode, but one of the things I've really appreciated is you can ask all these managers who all are quote unquote CTAs or run managed futures program the same question, and they will give you different answers. And if you listen to all that, it becomes really patently obvious why they have such different returns. Right? I'm at the point where to say managed futures as a category is like saying active stock pickers. Like there's just LLCs, right? It's just like, what a ridiculous category at this point. Like to not subcategorize further is, I think, insulting to the time and effort these managers put into pursuing different factors and strategies.
What I want to say was maybe Marty Bergen from Dunn pointed out too, is like, even if you have managers that say they're doing the exact same thing, there's a huge dispersion in their returns. Even if they're all like long-term trend followers, so they're using a 200-day and a 50-day, whatever it is, they seem like they're doing the exact same thing, but the dispersion. So there's a lot of nuance there that people don't realize. And I think they even asked, Marty Lueck was saying, you've been in this for decades, you've run some of the biggest firms in the space. Don't you just know everything about trend following? He's like, no, I'm still learning. We're still adjusting. And it's that red queen principle. So like, to your point, It's like, it seems easy until you really get under the hood. So I'm glad you brought up, they've had some of the big people in the space. So what they did is they got, on the SocGen CTA index is you have to run several $1 billion. It's like the largest 10 to 20 like managers in the space, the largest 10, I believe. So they had a lot of those managers on it. And one of the questions that Niels kept wanting to ask them is, what are their thoughts of a replicator ETF? You know exactly who they're talking about.
Yeah.
And it was really a setup question. But I thought it was the most interesting nuance I saw. It was like, I don't think that this replicator ETF, who shall remain nameless, or unless you want to give the name, is the, there's nuance there. And I think they've always been transparent about what the risks or the issues or trade-offs you would have with a replicator index. To me, and you and I always talked about, the more people that get involved in managed futures, CTA trend following, the better for the space. So the more it becomes part of people's educations or portfolio selection, the better it is for all of us. So I've never really had that problem with it. One of the best arguments I heard against it, and this might have been from Marty Lueck, was like, what happens when they abandon the narrative? Like if it starts underperforming for a while and there's no narrative except for replication, humans require narrative. And if they don't have a manager to talk to about narrative, I thought that was an interesting way to think about it.
I think that's a great comment about the real world behavior of people, right? Of allocators. That is absolutely true. If it stops meeting its mandate, if it's supposed to replicate and doesn't replicate, there needs to be a clear answer. Look, replication, I think it's very odd that replication is broadly accepted at this point in active equity managers. That's what quants are largely doing with factors, right? We're saying, hey, value, we think we can systematize that. You don't need to buy a value manager. We can capture that, right? Profitability, quality, all these different characteristics and factors. We think we can look at some manager's return stream and decompose it into beta and all these other active factors and explain away almost all of their alpha. So now active managers are going to rebut that and say, well, the value's added at the edges and you can't replicate what we do and all this value add. So I'm not surprised when I hear the same thing on the hedge fund side, right? But I think the track record, and look, I don't have an issue shouting out Andrew Beer, DBMF, who's done a phenomenal job in their track record of tracking the SocGen CTA index. Andrew would be the first one to say there are inherent limitations of tracking different hedge fund strategies. CTA just happens to be a category where when you blend all these managers together, their average is something that you do seem to be able to replicate. Can you replicate them precisely? Well, I know for a fact that someone like Man Group, for example, they're going to do trend following on inflation swaps. Man Group is looking at trading apples in China. That's not going to happen with a replicator. But if those positions are, if Man Group's doing that, and then there's 20 other managers that are getting averaged together, like it really only takes 15 to 20 of the highly liquid global contracts to capture the big muscle movements. And if you can replicate the broad sort of average of these managers with the big muscle movements, and you miss the little subtle nuances they're adding, but you charge a way lower fee, that fee alpha may more than make up for the extra alpha that they can add individually. So look, every manager is going to say, no, you should just buy my fund. Of course. There's an agency issue there. But I think, if we accept it in the active equity space, we should be open to it in the hedge fund space.
Yeah, I think there's several things in there. One is, to me, like the other argument is like during dislocative environments is where you're going to see the underperformance from DBMF. I don't know if that's going to be necessarily the case. We'll have to wait and see. But my answer is almost like yes and yes. I think that DBMF is great. I think active manager trend following are great. Net over the long term, will they probably end up about the same? Probably. We'll see, or maybe we go halvesies. But you had the question in there, or it was part of your answer, is like, so two betas make an alpha if you combine them?
Two betas always make an alpha.
But the other question I had for you is like, do you know, did you fulfill the Pirates pinky promise?
I always fulfill the Pirates pinky promise.
I know you're here. I mean, that's part of the bargain, is like part of the Pirates pinky promise is like Corey and I show up. I was going to say every Friday, but most Fridays, maybe not every Friday.
Frequently enough.
But we try to provide some mildly valuable entertainment. Today might be just down the nerd rabbit hole, so not very entertaining as usual. But our Pirates pinky promise with you is, you know, we need you to subscribe and hit that notification bell so you know when we're going live every Friday. It's surprising how many of you, Booty Crew aside, are not subscribed to the show on YouTube, and we need those subscribes, those notifications. You know, share it with your friends. You know, print out PDFs. You know, share them with your neighborhood. You know, stuff them in their mailboxes, whatever it takes. But we have this pirate pinky promise with you guys, and we really appreciate it. But Corey, going back to replication, this is what I thought was interesting that jumped out on Twitter though. On the replication thing, is it came out this week. Everybody's like, if you look at the last 2 years, the CTAs, they've essentially been just long USD for the last 2 years. Like you could have replicated the last 2 years with long USD. And I go, okay, that's fine. But aren't you glad that they captured it? And then you can only know in hindsight if it was long USD. Like, how do you think about that?
100%. 100%. It's so easy to say, oh, that was such an easy trade. They were just long USD. They were, right. And by the way, short rates and long USD ended up being like the perfectly negatively correlated trades. So they were short rates and long USD, which ended up being the same trade. So it didn't matter which one you did. It looked identical. But yeah, the point is they did it, right? If you look at their correlation to stocks and bonds right now, you know, rolling, say, 60-day, 30-day of the SocGen trend index versus U.S. stocks and bonds, it is at pretty much a multi-decade low, right? At a time when stocks and bonds have hit a multi-decade high in their correlation. But if you look, those correlations are wildly time varying, right? So to say, oh, it was an easy trade, they were just long the dollar. Yeah, but you want to know what? This year, they could be short the dollar all year. Like the whole point is we don't know the way in which these trends are going to manifest. They have set themselves up to dynamically trade them all. This is when we talk about, I've gone on this rant before. I hate the word inflation. Inflation is such an umbrella catch-all term for all these economic things that are going to affect asset prices in all these different ways. Do you have monetary inflation, in which case you probably want to be short your local currency? Do you have supply-driven inflation? Do you have demand-driven inflation? These are all going to affect asset classes in totally different ways. And so, like you saw people, I knew people who went really long gold in 2020 because they said inflation is coming. They were 100% spot on with the umbrella term of inflation and 100% wrong with the asset they chose. Right? To me, again, that's why I love managed futures personally. It's this dynamic strategy that can adapt. And the trade last year was short rates long the dollar. Great. They won. I don't know why we're upset about that. Why am I upset about that, Jason?
I don't know. It's just because it's just the shit slinging on Twitter is like that, you know, once again doesn't capture the nuance. By the way, is my mic popping at all? Scott said it might have been, but do you hear it? No. It might be just my inability to pronounce words and I'm just popping my P's. So two more questions on that, and I want to jump to another topic. One is, as they brought up again, which I always love, is, you know, Sharpe ratio is originally meant for at the portfolio level, not at the individual strategy level. And, you know, do you think we're ever going to get back to that, or just people have just gotten so we're going to get into this thing that you brought up before, is like we talk about behaviorally, right? Like if DBMF underperforms, if people can't have a narrative, they might lose faith in it, so to speak. So once again, on Sharpe ratio, is it just narrative that just people like to look at Sharps, and almost everybody looks at it on individual strategy? Nobody actually applies it to a portfolio construction.
Yeah.
Good answer. Good answer.
That's my
good
answer.
Yes, I'm moving on.
I mean, it is my eternal frustration that you can offer a strategy with wildly beneficial diversification properties that strategy can have a low Sharpe, but when added to your portfolio can be incredibly beneficial. You can have a strategy with a negative Sharpe that can be beneficial to your portfolio. It's called insurance, for example, right? And yet the way we evaluate strategies in this industry is on a per strategy basis. And we cannot get away from it. And I think it's massively detrimental to the way people build portfolios. A perfect example, NTSX, my favorite levered 60/40 fund. Go
Oh,
look
that
at
was
the
my favorite
fund
90s
flows.
band. I thought you were saying. Oh, sorry.
Yeah. NTSX from Wisdom Tree, US Efficient Core. 60/40 levered up 1.5 times. Go look at the fund flows on Morningstar. Just pull up it on Morningstar. You will see as it outperforms large cap, it gets all the flow in, and as it underperforms, it gets all the flow out. But here's the reality. If you were using that fund correctly, simply to replicate a 60/40, instead of putting $100 in a 60/40, you can put $66 in a 90/60. On a dollar basis, you would have lost an exactly equivalent amount of money, even though NTSX was down, I don't know, 20 something percent last year, and a 60/40 was down something like 13. On paper, it looks way worse, but sized appropriately, you would have been down the same amount of dollars. And so my frustration is we look at percents. We don't consider the size in the portfolio. We don't consider how it's going to contribute to the portfolio from a diversification perspective. And as managers, we're kind of prohibited from offering that evidence other than saying, look at the correlation to stocks and bonds, and maybe we can show a hypothetical portfolio, but that verges into the realm of back testing that FINRA's going to bitch slap the shit out of you for.
That is a technical term, by the way, for those listening. Speaking of the behavioral biases, one of the things that also came up that I can never get it right, empathetic or sympathetic to, is the managers, and this is also why you have to really dive into the nuance of CTA trend followers. It's just a catch-all, so you have to dive into the individual strategies. Is one of the things they've done to improve Sharpe ratio at that portfolio level of their sub strategies is they include a lot of carry strategies or other mean reverting strategies to make the Sharpe ratio of their trend following look better. But at the same time, so I can understand, because they need investors to invest in their products. So if they're offering straight trend following and it goes through a few bad years, they're likely to cut that allocation. So they're looking at it from the perspective of how do I get these allocators to keep this allocation? We'll have to mix in these mean reverting or implicitly short vol strategies to improve my Sharpe ratio, so that way they will be able to allocate. So I think this goes back to, once again, the reality of humans interacting in this space versus what's ideal. And I can understand why they want to do it.
You saw this all throughout the 2010s. Pure trend followers started to include carry and all these other strategies and became, in my opinion, much more systematic macro, right? Carry, mean reversion, relative value trades. And there's nothing wrong with that stuff. Full pause. There's nothing wrong with that stuff. It's just a different product, right? And I think if you're introducing that product into your portfolio, it's going to have very different tail dependencies than a pure trend following strategy does. And if you're considering a pure trend following strategy versus that strategy, I think you have to very seriously consider what all those other strategies are contributing. It may have a better Sharpe ratio in isolation, but a lot of that extra Sharpe may come from a positive correlation to the assets you already have, or at least the tail cases of the assets you already have in your portfolio, right? So you're buying a higher Sharpe ratio portfolio, but a lot of that Sharpe is exposure you've already covered. Right? It's not actually beneficial Sharpe to your portfolio.
And then the art versus the science is, it's about getting those ratios right. Like if you're adding those things like carry or other strategies to help with that Sharpe ratio, but you still want that profile you get from a trend follower in like last year in the 2022 or 2008 environment. Like, how do you think about even pairing those? It's all about getting your ratio right, and you want to have almost as little exposure as you can to just help that carry out during the intervening years, or like how? Like that's a really tough question.
That's a tough question, because it is ultimately what's the mandate. If it's an absolute return strategy, right, you're probably not going to get the performance of what happened in unless your vol is high enough. What happened last year with trend following? Like you might just be up very continuously 7% a year, which is admirable, but it's not going to be the hedge to equities and bonds that are in your portfolio the way trend following has historically served as a hedge to inflationary environments. So yeah, it's a I don't think there's an answer here. I've struggled against this one for 15 years in being in the ETF and mutual fund industry, and products get evaluated on an individual basis. And so I think there is, because of that behavior, managers are incentivized to increase the Sharpe ratio of their product at the cost of the utility of the product to the larger client portfolio.
Man, so well said. I was actually just having a conversation before we jumped on with our homie Triple J, and he was saying, basically, we were talking about similarly, is like, it takes an enormous amount of energy to go against where every part of our industry is moving to, and every part of our industry is catering to what the clients want and not not what they actually need. Right.
Yeah.
And so it takes tremendous amount of energy to try to fight against those trends and create products that you think are right, even if they're just a tiny minority of people are willing to even agree with you on those products.
Speaking of products that I think are right, I want to talk about new NFT platforms.
Perfect. I was going to the transition, so you need to teach me about Blur. I've purposely not been looking at your text or not following it closely because I want you to teach me about what's going on NFT land, Blur, whales, etc.
Here's the deal. We've got like 9 minutes. We're probably going to go a little long, but the good news is we've constrained ourselves. And if you're anti-crypto, anti-NFT, I think there's still a lot of interesting stuff here to just think about from a markets perspective. I find this stuff absolutely fascinating because it's like a petri dish of all the weirdest financial bacteria going on at once. All right, so we have NFTs. You can just think of NFTs as some sort of unique tradable asset. Hate them, love them, whatever, they trade. There's these different platforms you can trade them on. So OpenSea is the biggest one, and then competitors have popped up. There's SudoSwap. There's a platform called LooksRare. There's a new one called Blur. Now, OpenSea was one of the first and got the most volume. And so when other platforms started, the way they tried to get people to come use them is to incentivize them by paying them with a token, right? We've gone over this in the past. This really isn't all that different than VCs subsidizing your Uber ride, right? You were getting paid. It just wasn't you were getting dollars. They were just making the cost of your ride lower. Well, what LooksRare and Blur have done when they launched is they said, hey, if you come list or if you come buy, we will pay you every time you execute on our platform rather than the big gorilla OpenSea. We're going to pay you in our token. So first things first, Jason, this whole idea of like issuing tokens and paying people in the tokens you issue is sort of a head scratcher to me. Because like from a money perspective, it's very weird to think about why this should have any value, right? Like if you and I live in a world where everyone uses blue rocks as currency, and I come around and I'm like, hey, I've got some red rocks. I think we should use these as currency. And if you come to my store, I'll pay you in red rocks. Like, why in the world do you assume those red rocks have any value? Right?
Perception is the only, and self-delusion.
Yeah, the other thing I think about is I go, okay, like if I want people to adopt my red rocks, what I probably need to do is say, by the way, I'm willing to set an exchange where you can come to me and I will trade you, blue rocks for red rocks. And there's a certain amount of liquidity that I'm guaranteeing. I think in that sense, if I then give a bunch of people red rocks, well, those red rocks end up being in circulation worth as much as you can sort of then say, okay, how much could I sell them for the blue rocks, right? So this is equivalent to if LooksRare launches a Looks token and they start a liquidity pool and they dump a bunch of Ethereum in there or Bitcoin as a pair against the LooksRare token. Well, I sort of look at that as saying like that they're sort of airdropping Ethereum in a certain way. It's just whoever gets to the pool first to dump their token to extract the Ethereum, like, well, that's the total market value that's left. And then there's a whole bunch of like frothy trading around it, but you're sort of like backing the token with that much. But at a certain point, like once that all gets extracted, the token goes to zero. Like unless it's tied to fundamentals, all this shit just gets farmed to death. So there's a weird aspect here of, all right, why are these tokens even worth anything other than sentiment? Well, maybe you could actually say like, if the platform who's launching it backs it with some amount of other currency, like, it should have that sort of fundamental value to it.
Or if they start like distributing a percentage of the commissions, I mean, that's usually
right. If you're tied to a fundamental value,
yeah,
and then you become a security, and then it's all sorts of issues. So, So interesting open question there of like, okay, you're paying for liquidity. How, like, why should the token you're paying with have any value? I do think a lot of it's just sentiment bullshit. But there's two other interesting aspects here. So the way these NFT platforms try to incentivize people is they say, look, if you have an NFT you're trying to sell, put your asks on our platform. And as long as you list it near the floor where things are sort of trading, we'll pay you. And conversely, if you want to buy an NFT, if you put your bids near the floor, we'll pay you. And I think the way, like, this is going to go back to our options conversation. The question we should ask ourselves is like, well, are we being paid enough? You know, if you were going to buy or sell anyway, fine, it's sort of free. But if you're going to be a market maker on that platform, which, by the way, I get that the idea of being a market maker in NFTs and crypto is sort of insane. But one of the things to think about is, well, if I have an asset and I'm listing it for bid, I've effectively sold a call, right? It's a covered call situation. And if I'm listing an ask, it's a covered call. If I am just leaving a bid out there to buy, I'm effectively short a put, right? And one of the things we can think about doing is saying, well, let me calculate how much I'm going to earn in these airdrop rewards. And that's sort of the premium I'm getting paid for selling those options. And then you can actually back out a pseudo implied vol. Mm-hmm. And you can say, do I think that implied vol is rich or cheap? And it's pretty interesting to sort of try to back out those numbers. And it's not perfect, right? Like, clearly we're dealing with very weird assets here. Black-Scholes is probably not going to be what you want to use, but even if you use Black-Scholes as a proxy, like, you can sort of say, like, for certain assets, wow, that implied vol is way higher than the actual vol of the asset. Well, this is a great thing to maybe be to earn the rewards in. And then there's other assets that are super volatile in their price that you go, those same rewards are not, I can't justify doing it. Right. So I think there's an interesting, like, if people are considering this, there's an interesting attachment into the traditional finance world of understanding what you're effectively doing, that can help you figure out whether it's positive EV, positive expected value to be doing some of this stuff.
Or would, by the way, the maker taker model is essentially a market maker model. Like, we can call it whatever it is. Like, we don't need to create the analogy, but that's, you know, the whole maker taker in crypto means you get paid or you get cost depending on what side you're on. But so would you, I'm thinking, like, what would be the end goal? Like, in that scenario is, like, typically I know a lot of people just sell their tokens right away because, you know, they don't want to take that risk. But are you saying if you did your own theoretical implied volatility models based on, like you're saying, whether, you know, backing that out, is that would determine your length of hold period on that token? Is that where you take advantage of it?
No. So just to be clear, like, let's say I own a Bored Ape. Let's make this concrete. Yep. Let's say I own a Bored Ape, and I wanted to make some money. I don't want to sell the Bored Ape, actually, but I want to make some money. Maybe I write some calls on it. Now, the risk is obviously it's going to get called away from me, right? But what I can do is I can go to LooksRare, and I can say, okay, if I start to put my ape for offer at a certain price, how many tokens do I think I'm going to earn for just listing it? Those tokens, how much can I sell them for immediately in US dollars? Okay. Given that what I'm listing for, what I think the asset's worth versus, you know, basically how much I'm going to earn on those tokens, what's my yield? You can sort of back out a dollar premium. Right. And then you can say, okay, well, I listed it for a certain price. That's my strike. The floor is at a certain price. That's the current asset level. This is a call option I've sold. I know what the premium is. What's the actual implied vol? Do a reverse Black-Scholes. And you do that and you say, okay, the implied vol is X. And then I look at the realized vol of this asset, you know, maybe as a proxy. And I say, do I think I have enough, you know, spread between that I think implied vol is rich or cheap, right? There might be
you're getting paid well for listing is what you're saying.
Yeah, that you're getting paid well for listing. And conversely, on the other side, if I'm going to leave bids out there that might get hit, and then I'm going to be stuck with the inventory, how much am I actually earning, right, to write that put option? And there's some assets that you might be earning way more than others.
Wouldn't the confounding variable be time? Like, how often are they releasing these platform tokens?
That is a great question, right? So looks rare is every single day. And you're accumulating your points every 10 minutes, right? So you can think of it. So if you were actively managing this, and by the way, if you're actively managing it, you're going to incur gas fees that in changing your position. So you got to take that into account. But you're doing it every day. Blur is doing this in what they're calling seasons. And so you're accumulating points over months, and then you're going to get one big airdrop at the end. So there's two parts. You're getting a massive amount of variable exposure. Now you could list for a day and then take off, right? And you've earned those points, but you're only going to get the amount of airdrop proportional to your points to the larger points earned. But you're not going to get that airdrop until 3 months from now. Well, who knows what Blur is going to be worth 3 months from now?
So how can I counterparty risk? Yeah.
Right. I've got not just counterparty risk. It's like, I can't say what my premium is because Blur might be trading for $1 today, but by the time I get it airdropped, it might be 10 cents. And then the premium is 1/10 of what I thought I was listing for. So the options model is a lot harder on a platform like Blur than it is on LooksRare. So there's all sorts of interesting things here. I want to talk about Blur just for a second, because there's been some really fascinating trades that have happened. So Blur, the airdrops have been enormous. Like, we're talking people making tens of millions of dollars from farming this token. And by farming, what they have to do is they have to list their NFTs for sale, and they have to be putting standing bids. And so they've done season 1 and season 2. Season 3 of the airdrop, I think, is going now. Or maybe they've done season 1 and they're now in season 2. I might have that backwards. But what happened is you have these massive standing bids that all of a sudden these NFT holders are going, oh, I can take my really illiquid NFTs and sell them all at once. So as an example, this week, 2 holders of Bored Apes sold in basically one big transaction. It was a couple smaller transactions, but it was like within 10 minutes, they sold 72 of their Bored Apes. They sold some mutant apes, and they sold some other NFTs. And they basically walked away with $9.9 million without even affecting the floor price of these assets. That is an astronomical amount of volume in these NFTs in a very short period of time. You would expect that typically, like, I haven't looked, but I would expect the number of Bored Apes that trade per day is like 5 to 10. To sell 70 plus in like a 10-minute period without moving the floor is because these people have all these standing bids on Blur. They're just listing the bids to try to farm this airdrop. Well, now all these people are stuck with the NFTs, right? And the question becomes, all of these people who are holding NFTs that are suddenly getting this liquidity unlocked and are able to dump into these Blur bidders, what's going to happen, like, when these Blur bidders don't want to hold the inventory anymore? Right? Are they just going to sit there and the inventory is going to just decay in their wallets and those NFTs are forever taken off the market and the supply goes away? Are they going to try to turn around and flip them, which ultimately just puts downward pressure on the floor? Are they going to end up at the end of this? Are they going to relist them, right, and get all the relisting bonuses? And then at the end of the airdrop, just liquidate them. And 3 months from now, you're going to see these floors completely collapse 30 or 40%. As they should have when 70 plus Bored Apes were sold at once. Like, to me, it's just a delay of the transmission of what should happen to the market.
Stability breeds instability. Yeah. What's your volatility doesn't get destroyed, right?
Yeah, something like that. Risk isn't destroyed, only transformed. So I know that's a lot to digest, but there's this huge wave of volume and transactions happening in the world of NFTs right now. And the 2 guys who actually sold the Bored Apes are ex-traditional finance guys who worked in distressed credit. And they said, look, when you hold an incredibly illiquid asset and you get liquidity, you sell that asset, right? Wow. They unlock $9.9 million for themselves, which is great. Good for them. But they were crowing about how it didn't affect the price of the asset. I think it's just a delayed transmission. I think the floors of these assets are absolutely going to crater as soon as these token farmers sort of just don't want to wear the inventory risk anymore.
The only possible thing that doesn't destroy the floor, tying it back into TradFi, is that it becomes a locked market like housing is right now, and people just don't want to sell, right? And they're taking those apes off the market. That's the only thing that survives the floor crashing, right? That's the only countervailing force.
Yeah. So one of the people who has eaten a ton of volume is this single account called Machi Big Brother. I think he's put 300 ETH plus into these NFT, way more than that. 3,000 ETH, I think, into these NFTs. I mean, he was the one who digested the majority of those Bored Apes. I think it happened while he was sleeping. The account seems to be live during Asian hours. He puts these massive bid walls. So he's basically saying, I'm willing to buy 50 Bored Apes at, 70 ETH. Doesn't expect to get filled for all of them, but he's earning tokens, airdrop points for just having the bids there. Well, they filled him, and he woke up with all these Bored Apes. Now, he has historically been someone who has owned a lot of Bored Apes. I don't know if he wants to own 70 of them, 70 more than he already does, right? But I don't think he's going to try to destroy the floor because it would only hurt his other holdings. But he's been this today and yesterday, he's been trying to liquidate a lot of them here and there. He'll sell 5 and then someone else will fill them for 2 and then he'll sell 6. And, it's like this war back and forth of trying to get rid of the inventory. I think for the smaller projects, though, where you have real mercenary liquidity, I think you're just going to see these floors collapse as people are taking advantage of the instant liquidity. And then it's just, again, it's this delayed transmission mechanism that all of this mercenary liquidity is just going to try to get all that tied up value out. And it's sort of this, like, it's a weird prisoner's dilemma, right? Because all this mercenary liquidity is like, who's going to dump on the floor first, right? If I know that the airdrop game ends tomorrow, do I front run everyone else and sell all my inventory into their bids and they get some extra points, but I'm out of my inventory risk? Well, if everyone knows I'm going to do that, why doesn't someone just front run me the day before? And someone front runs me the day before. And I don't know how this is going to play, but I think it ends in tears.
Has there been any, assume there is, like, conspiracy theories that Blur is in cahoots with, like, these whales that are trying to liquidate large portfolios?
No conspiracy theories that Blur is in cahoots with the whales. What is fascinating, though, is like when you look at the vast majority of volume on Blur, it's coming from just a few accounts. Like, there are a few accounts that are absolutely racking up a tremendous amount of buy and sells. And that, right, they're burning the bid-ask spread and they're burning the ETH of the transactions every time they do it. But they are accumulating the vast majority of the points. Blur has said they're dropping 300 million tokens at the end of this sort of airdrop season. The token, I think, is worth $1 right now. So if the token goes down to 20 cents, right, you're still talking about $60 million up for grabs. Now, when you get the token, then everyone tries to dump it again. And so, what can you actually extract? But I think it's a big question. Who's going to dump on the floor first?
So many things in there. Who's going to dump on the floor first? Can you imagine, back in the day, whether not that either of us ever traded perps or on BitMEX or leverage trades or anything, but like, you remember, like,
never.
If you were to do that, like, sometimes you'd wake up in the morning and you'd be closed out of your position. Can you imagine waking up in the morning to owning 70 apes?
That's a lot of apes, man. Right? I mean, that's a lot of apes. Other interesting development in the NFT world. You remember Three Arrows Capital?
Yeah, of course.
Their portfolio, their NFT portfolio, is up for liquidation. So in trying to recover assets for creditors, they have a tremendous number of NFTs that are going to come to market. Some in projects that have historically fetched a fair value. So Fidenzas, for example, is an art project that I think there's been the floor somewhere around 70 ETH, but they have, like, I don't know, a dozen Fidenzas that they need to sell, right? And the floor can't digest dozens of Fidenzas. Another one is this Art Ringers project. There's a very famous Art Ringers NFT called the Goose, because it's shaped like a goose that Three Arrows Capital owns. They'll probably put that to auction and recover a decent amount. By the way, I've totally lost you on camera. There we go.
All right, let's just stop camera for a second. No worries.
Okay, all good. So it's going to be, again, at the same time you have all this blur airdrop farming, people throwing their NFT liquidity into this mercenary airdrop liquidity. You've got Three Arrows Capital, whose NFT book is going to get liquidated at the same time. I think it's going to be tears at the end of the day for the NFT world.
Are you? But at the same time, are you excited to get your juice back? Talking about all these vocabulary words again, and saying all this stuff with a straight face. It's been a while since you've been in this game.
I feel like I've wasted so much brain space on this. But this, honestly, you know what? This is my Sunday morning cartoons. Like, this is just my pure candy. Like, it's just kind of fun to track some of this stuff because it's so insane, but it's market adjacent. Like, understanding traditional finance markets helps you understand, hopefully, what's going on in this space. Tons of people trading in this space are not, traditionally finance market trained and may not understand, like, that standing bids and offers are sort of like writing puts and calls. That gives you, hopefully, an edge if you are trading this stuff. But man, oh man, it's exciting, ridiculous times in the world of crypto.
Well, I think you said it perfectly. One, I'll go back to your trademark that crypto is speed running traditional finance, right? Learning on its own in a sped up time frame, which just want to give you always credit on that. And then the second, which I think you're getting more to here, that I think it's really fascinating, is it forces you to rethink traditional markets as well, and the structures and the different strategies we use. It brings back a lot of that, like almost like really finance 101 concepts, and making sure you have them nailed down to understand what the crypto is doing, and vice versa. And so it brings up a lot of things that maybe you or I haven't thought about in decades. And I like that. It makes you think the frameworks that work, and what is this similar to, and what are the past examples of this where it worked out poorly, and see like how close those analogies are, or if they're different nuances.
Right. Yeah. One recent one that came up was, so SudoSwap, which is another NFT platform, as Blur is doing this airdrop, they decide to launch their own token. They had a token before, sort of somewhat related, called XMON, which I had been a long time holder of. And I wake up one day to find out that, well, if you are willing to lock your XMON, you get X number of pseudo tokens. And there was a very clear like market inefficiency where people hadn't done the math to realize there was like an arbitrage where you could buy XMON, lock it up, immediately dump the pseudo token, and XMON could basically go to zero and you would have made money. Like, it didn't matter that whether you were getting your XMON back in a month or so. And just like being, I don't want to say classically trained, but trained to think about, okay, there's in these several steps, have people thought through the implications, or are they just acting out of behavioral impulse, and that's creating an opportunity? What is fascinating to me is the opportunities still exist in crypto when you see that stuff, but they're getting closed faster and faster.
Well, I was about to say the worst part of that means you got to stay up 24/7, and you got to be on top of this stuff. That's the hard part, right?
The good news is I don't really care. It's fun when it pops up. I'll trade it when it pops up, but it's just fun to keep my finger on the pulse.
I'll try to close the loop, so to speak. Is also on Top Traders Unplugged a while back. They had Perry Merling, that loves talking about like euro dollar markets, the history of dollar. Charles Kinderberger's like his latest book, but it had me thinking about crypto adjacent is like the circular nature of just like economies and everything we do in general. So for example, he was talking about after, World War I, the reparations we made Germany pay was basically the US provided loans to Germany so they could pay, France and England a heightened interest rate. So that way France and England could pay the US. And I'm like, how's that not a circular economy, right? And then so we learned from that, from the debt side, too high of interest rates. So then we provided an equity loan basically after World War II to Germany to do the same thing. And it's just like the circular nature of getting the money back to us with all the intermediaries involved. It reminds me always of a Florida neighborhood, right? You start looking around the Florida neighborhood, you're like, wait, this is the realtor, this is the mortgage provider, this is the contractor. And it just feels like this just like circular economy of services. In the same way, that's what I'm saying. It's not a disparaging way of looking at crypto, but it is just like this system of circular flows. and everybody like, so how do you extract your rent from that? But it's just, I can never really wrap my head around in general, like, is the general economy a closed loop Ponzi system or not? It's hard not to, when you see these kinds of things, to look at it that way.
Last thing I'll add on the NFT side, right, is you think about knowing about buyers and sellers, and especially with an asset that doesn't necessarily have fundamental value. A lot of these NFTs don't have fundamental value. Some do. I actually think Bored Apes, for example, is an example of a collection that's backed by a company with $5 billion, right, in cash, that is trying to create a brand. Like, they're going to spend a lot of money trying to make that into something. If I know that 72 apes were just sold, and at the end of this airdrop, like, the floor might crash. Well, if I'm thinking about being a buyer, there might be a much more opportunistic time at the end, in the end of this airdrop season, because you're going to have all these people trying to get rid of their inventory. And so I think that knowing, right, that there's a wave of selling that's likely to be coming over time, and keeping your eye on how much excess inventory has been built up for these mercenary farmers, I think can help inform, better buying if you're into that stuff.
The only problem is you don't know where how long that floor extends, or to what's the depth
of
that selling pressure, right?
That's absolutely right. Well, actually, you do a little bit, right? Because these are all on-chain wallets. So you can, in theory, track where they've all gone and sort of try to figure out, is this mercenary liquidity or not? How many of these have sold? So there is actually a weird amount of transparency that can go into it. That said, you don't know how many other people are thinking the same thing and going, "Ooh, this is going to be a great buying opportunity," and then you're all going to front run each other, and the floor never moves, and the liquidity does show up. So who knows? But I do think, again, edge, in my opinion, typically comes when you can figure out exactly who's selling, why they're selling, when they're selling, right? And you can be a counterparty on the other side to that, either selling before them or buying, at a much more attractive price.
And what's forever going to piss me off is being early is the equivalent of being wrong. And I was all over crypto kitties. Why did it have to wait for punks and apes? Why couldn't it have been the crypto kitties? Anyway, thank you for everybody for this extended version, and especially getting into crypto. We maybe got down to one listener, as we like to do, as like literally let it all the way down to one member left of the Booty Crew. But please, like, subscribe, turn on those notification bell. You got to adhere to the Pirates pinky promise. But in general, remember,
a hook is the pinky promise like a hook promise?
I think my pinky is too small to like even hook. Like, yeah,
broke my pinky playing lacrosse. I actually can't do that.
Oh man, that's the biggest Chad Laxbro thing I've ever heard.
That was.
Remember, none of this is investment advice. Hopefully, it's for entertainment purposes only. We strive to entertain. That's part of our pirate pinky promise. But otherwise, we look forward to seeing you all next week. I think I'll be on the road, but we should still be live on Friday at 3:00 Eastern, 12 Pacific. Thank you for.
I might have a baby on my chest.
There we go. Let's do this.